We're finding that with house prices increasing, more and more we're assisting first home buyers to enter the market using parental guarantee loans. This is about giving you a brief overview of how these types of loans work and the benefit of taking this option. To be eligible for a loan, you must have a parent or a relative that has a property with sufficient equity and a desire to want to assist. So here's how it works. Let's say your parents have a property that's worth $700,000 with a $300,000 mortgage. This means that they have $400,000 in equity. This is the value of the property less the current debt. Let's also say that you're looking at purchasing a property for $500,000. This would entail purchase costs of $5,000, so in total you'll need $505,000 to purchase the property. Let's also assume that at this point you have $10,000 in savings that you're happy to contribute. A deposit loan is set up against your parents' property. The deposit loan is 20% of the purchase price, so in this example $100,000, plus purchase costs of $5,000, so in total $105,000. From this, we deduct your deposit of $10,000. This means that a $95,000 loan is set up on your parents' property. Then, a loan of 80% of the value of the property is set up against the new property that you're purchasing. This is an amount of $400,000. In total, you've borrowed $495,000, but it's split over the two properties. Both of the loans are in your name. If you're late on a repayment or default on the loan, your parents' credit record is not marked. If you default on your loan, the banks will sell your house and pay out the $400,000 loan. Any funds left over will be used to pay out the $95,000 debt. If there's a residual debt, then you are still responsible for making the repayments on this loan until it's paid out. If you don't make these repayments, then your parents do become responsible. And if they don't make the repayments, then the bank will take their house and sell it too. This is the worst case scenario. Some lenders will insist your parents get legal advice before taking out this type of loan to ensure they understand their responsibilities. There are, however, some significant benefits. You don't need any type of deposit for this type of loan, but you do have to show good spending habits with regards to your money. There's no lender's mortgage insurance, so this could be a saving of $10,000 to $15,000. Often, also, you'll get a cheaper interest rate with this type of loan. There are some parameters around the parents being eligible, but obviously each situation is unique. So if you think this might be an option for you, then the best idea is for you to give us a call and we can discuss this in more detail.